And this procedure was introduced in Austria in 1995. If we compare this to other European countries and the US, it's a little later. So most countries in Europe introduced such proceedings in the 1990s, 1980s. And also if we think, well, is it more lenient, nachsichtig, more debtor-friendly, the bankruptcy proceedings, and then Austria ranks like in the upper half, so it's rather debtor-friendly, and it also has become more debtor-friendly over time because there were several reforms since 1995. What's the motivation for research? So first, for debtors, this kind of consumer bankruptcy proceedings provide insurance against unexpected financial shocks. So if I know that I can get rid of some of my debt, this is some kind of insurance. On the other hand, for creditors, so there's the means of retrieving some of the claims in kind of a foreseeable, regulated manner. So of course, also outside courts arrangements can be made with the debtors, but this can provide a legal framework for doing so. Of course, there are some moral hazard problems you're probably already thinking about. So there's cost and benefits of this debt relief. On the one hand, there are kind of positive externalities, positive economic externalities. So there's a literature that shows that debt problems worsen health. So if I'm under stress, if I get calls from the creditors, when do you pay? And this is, if you have multiple creditors, so this is a problem for your health condition. There's also literature that shows that the opportunity of debt relief can increase labor supply and earnings, and also entrepreneurial activity. And also there's this fresh start idea coming from the US that a quick debt relief for people that are insolvent should allow them to start again, to have a fresh start in economic terms. But of course, among various negative externalities, it can also happen. There's some evidence for the US on that the opportunity of having these proceedings and also reforms that make it more debtor-friendly can lead to increase in interest rates, because for creditors then it becomes more risky. If people know, well, I can get credit, and then if I can't pay it back, there's still the opportunity of debt relief within these proceedings. So there's kind of moral hazard built into it, and this can have adverse effects on interest rates. They increase, also tighten credit supply. And yeah, most studies are only about the US. So this again raises the question of external validity. The US has a different welfare system. Unemployment benefits that are one of the tools that aim at buffering economic shocks are designed differently than in continental Europe, especially in Austria. And yeah, this is one among many other arguments why we thought this is a worthwhile project to investigate. And also there's not so much literature on the topic in Austria. There's descriptive reports and figures published by debt counseling agencies and the creditor protection agencies, but nothing much more beyond that. So basically, we examine personal bankruptcy in Austria, and we focus on aggregate data. And that's also why we have a broad research question that states that we aim at trying to explain the variation of bankruptcy filings in Austria across time and regions. So we have aggregate data at different levels since the introduction of the bankruptcy proceedings in 1995. Sometimes the sample changes, but that's what we're aiming at. And we're looking at the broad explanatory factors that are mentioned in the literature, bankruptcy institutions, so the parameters that define how easy I can get rid of my debt if I'm a creditor, if I'm a debtor, but also macroeconomic variables like the GDP, unemployment rate, credit to GDP ratios, the structure of the population, so for instance, the share of different age groups, the rate of divorces, and also information that counseling agencies, what role they play in that. Just to have an overview about the long-run development in Austria. So this is the number of cases, quarterly bankruptcy filings, and it's differentiated between those that are open. There's also the opportunity that the court can reject filing. But we see a steep increase from the mid-90s to the mid-2000s, and then some fluctuations, and then again, a rather steep increase in around 2017, which is also part of our research project to address this steep increase, and this refers to this particular reform of the proceedings. And the picture is not much different if we rescale this to per 10,000 inhabitants and so forth. This is just an addition to the previous slide with more recent data, and just to give you a hint that at the more recent past, what we see here is after the pandemic, so in the 2 Corona years, 2020, the figures were not, did not react immediately to the economic shocks we experienced here. But then, and this is also what most of the NGOs and debt counselors and creditor protection agencies predicted or expected, it starts to rise again with a lag in time due to the closing of different protection measures for private households. There were moratoriums, possibilities to postpone credit payments, and we see some descriptive evidence that there could be a correlation here. Yeah, some short words about the literature. So, yeah, first and foremost, of course, this type of questions. So, what are the determinants of personal bankruptcy, of consumer bankruptcy, is investigated at both the aggregate level and individual level. So, there are studies using individual data, representative household surveys, but could also be data from clients of debt counseling agencies. And then, of course, that's where we most of the time fit in with our research project, studies using aggregate data, so basically counts of bankruptcies, ratios of bankruptcies across states, across time. And again, the huge bulk of the literature refers to the US. And we see different correlates or different factors that are correlated with the number or the ratio of consumer bankruptcies. For instance, we see many papers that study reforms in the US where the bankruptcy procedure became sometimes more, sometimes less debtor-friendly, and what can be shown is strong reactions of the number of bankruptcy cases. So if it becomes more lenient, more debtor-friendly, then bankruptcies increase. If it becomes less debtor-friendly, then bankruptcies decrease. So the cost and benefit of the institutional process seem to play a significant role. Then we see that the higher the debt to GDP ratio, the higher the number of bankruptcies. So as credit is kind of, for instance, that comes before debt problems, so getting credit then might lead to debt problems, and this eventually might lead to applying for personal bankruptcy. So a rather obvious correlation, but it's quite robust in the literature. Yeah, GDP unemployment, GDP, so the unemployment rate is possibly correlated with personal bankruptcies, more unemployment, more bankruptcies. We see that in recessions and downturns, an increase in bankruptcies, though the picture is not so clear here. Also, there are lags in the reaction. So this is not as robust as the other two determinants I've just mentioned. And we also see a relation between the height of the interest rate and the number of bankruptcies. So again, the more costly credits are, the less the likelihood, or the lower the number of bankruptcies we observe across states and time. Again, most of this literature referring to the US. We also see the other relations. So there's also studies that show if a bankruptcy reform makes private bankruptcy less debtor-friendly, then, or more debtor-friendly, sorry, so if it's easier for debtors to get rid of the debt, then also the interest rates on the credit markets react and rise. That's also what we see. And yeah, there's a bunch of literature on socioeconomic structures and socioeconomic characteristics and risk preferences. In a nutshell, those that are bankrupt are not the youngest and not the oldest. It's a group in between. And we see people with high risk preferences are more likely to enter bankruptcy. The low educated are more likely to enter bankruptcy, and so forth. And the final point, information stigma. So information refers to how well are people informed about the opportunities to get rid of the debt, the opportunities to enter bankruptcy proceedings, and also stigma, how is it rather stigmatized or not if you are bankrupt and want to get rid of the debt. Here, as far as we oversee the literature, the evidence is inconclusive. So some studies say, well, if there's less stigma measured somehow associated with personal bankruptcy, the number of bankruptcies lowers, but we also observe the reverse. So here the evidence is less clear. So what are the hypotheses, the main hypotheses we want to invest? So first, related to the parameters of bankruptcy proceedings. So the lower the cost of personal bankruptcy, so the easier it is to get rid of the debt in terms of the duration of the procedure or in terms of the requirements you have to bring in when you file for bankruptcy. the lower the number, the higher the number of bankruptcy filings, because then you are more prone to enter into this procedure, which is also for the individual related with transaction costs, etc., and time. Yeah, the more intense the economic shocks, this refers to GDP movements, but also unemployment rates, the more bankruptcies. So we observe recessions, and along with high unemployment rates, you observe a higher number of you expect a higher number of bankruptcies. Again, the credit markets, the cheaper and the broader the access to credit for private households, the more borrowers with a higher risk, ceteris paribus, and the more bankruptcies. Fourth, the more information is available on bankruptcy proceedings, and the more accessible this information is to over-indebted individuals, the higher the number of bankruptcy filings. So we operationalize this with kind of the density of debt counseling agencies. Of course, this is only one out of several possible approaches, but this is how we address this hypothesis and try to find evidence for this informational hypothesis. Just on a short point, so debt counselors are usually publicly funded people that work in NGOs that offer services, information to people with debt problems. And they are in Austria, they're spread across the country and work with these people. It's kind of social workers, similar to labor market service counselors. And finally, this relates to our socio-demographic variables. Again, we expect a higher number of bankruptcies if the share of middle-aged people is higher, if the share of divorce, if the divorce rate in a federal state or in a region is higher. And with this fit hypothesis, try to capture the correlation between socio-demographics and the number of bankruptcies. Now it's time for me to head over to Philipp to talk about what we actually found in this research project.
Thanks, Stefan, and thanks for coming. Also from my side, I'm going to present you the results now. And as you've already seen, the paper we are presenting, it really addresses a lot of different research questions at different levels with different data sets. So I'm going to give you the broad picture and the results that we have with all these different data sets and methods. So in terms of methods, first, we follow the Gross AER 2021 paper, where they basically predict or extend a time series trend, a very simple time series trend, into the future to evaluate a US reform. We also do that in Austria to evaluate the effects of a reform, to get an idea about the direction of the reform, the effect it had on bankruptcies. We also construct a national time series data set at the monthly level, where we apply vector autoregressive models. First, a simple Bayesian vector autoregression with a Minnesota prior. It was already argued in this literature very early by Sims and Tsar, 2006, that personal bankruptcies could also be an important factor in monetary policy VARs. And we identify this VAR by Cholesky ordering from slow to fast moving variables. We also apply a different VAR model where we basically use a package in R by Huber et al. 2019, which is also taking into account variations in parameters over time. So it's a threshold time varying parameter VAR. And then we also move to the regional level in our analysis and look at federal states and court districts. There we apply to a fixed effects penalty regression models, but also use the newer diff and diff estimators that are appropriate to some of the questions we look at. And then we also do simple OLS regressions at the micro level. So basically we go once through the econometrics textbook. And in terms of data, it's pretty interesting with personal bankruptcies because a lot of information is actually available. Every bankruptcy case is put online on this website that is highlighted here, with the name of the person who is bankrupt and with the address and with the birth date. So there's not much data protection there, but there's also a different interest by law that is basically overweighing this right to privacy, or at least that's what the Austrian legal system says. So we spent a lot of time in this project to scrape this data, to analyze this data. We were planning to use it also for this paper, but then we realized that basically after a certain time you do have a right to privacy, and the cases are deleted again. So this database is basically incomplete after the cases are completed. Therefore, we also reached out to the Austrian umbrella organization of the debt counseling agencies, and it was able to provide us with an anonymized historical data set that includes all the cases in terms of personal bankruptcies that occurred since 1995. So in the beginning, they started to transcribe this from the Wiener Zeitung, and then it also became digitized and so on. So we have daily time series data on bankruptcy filings in Austria, also down to the court district level. And to this time series, we apply various adjustments for our analysis, the time series analysis, where we account for calendar effects and seasonality. And so we construct different data sets. The VAR data set at the national level is monthly, and we look at bankruptcies per monthly workday, and we include several different covariates. The most important ones that we identify from the literature and where we have data in Austria. As you know, this is sometimes an issue. So we look at the unemployment rate, we look at consumer credit, the bank lending rate on newly issued consumer credit. We also look at the divorce rate, and housing loans as well. We do this also at the regional level here for federal states, and there we also take into account the different population sizes of states. And then we also, for some questions, construct a court district level yearly data set, and we also look at individual cases for Tyrol and for Vorarlberg, and I will mention later why. And so now let me come to the results. First, you see here in light blue the trend that was basically extrapolated from the Austrian bankruptcy time series. And the first vertical red line is when the reform, the Iraq 2017 reform, was announced in Parliament. So when it entered Parliament, we basically see that first bankruptcies dropped in anticipation of this reform because it made bankruptcy much more favorable for debtors. And then after the reform was implemented, the cases rose a lot. And this is not causal evidence in as we presented here, but it's pretty obvious that there was some relationship. And this was also discussed back then by the credit protection agencies and by the debt counseling agencies. And it's well known that bankruptcy policies relate to the number of bankruptcies you observe. But as we already saw earlier, this is one of the major factors of variation in this time series. What happened back then, the time to debt discharge was reduced, and the minimum payback rate was abolished. So that allowed many highly indebted borrowers to enter bankruptcy who were not able to do it before. Okay, now I'm already moving to the VAR results. Here we see impulse response functions. We see the effects of bankruptcy on bankruptcies of shocks in divorces. We see that these tend to have a positive effect on the bankruptcy time series in this specification. In terms of unemployment, the picture is a little bit less clear. To make this maybe a little bit more clear, on the left side we see the sample or the results for the sample for our entire sample period, and on the right side we see the results only for the pre-COVID time, because of course there was also a lot of upheaval during COVID. We had very large variation also in bankruptcies because during the lockdowns the courts were closed at first, and So there were no cases, just by definition. And at the same time, we had very high unemployment. So this is something that we wanted to look at also in our models. And so the first indication is that the results are quite different if you run the models for different time spans here. But there seems to be a negative effect of unemployment shocks, positive unemployment shocks on bankruptcies. Regarding the robustness of these effects of shocks, that also translate to the individual level. We also ran this with year-on-year growth rates. There we see that only the unemployment effect remains robust. And with the TTVP VARs, we see that the changes in the parameters between those two periods were not that big, while the parameters changed a lot for several variables in our model. For bankruptcies, the changes were not that drastic between those periods. And in the quarterly time fixed effects model, the contemporaneous unemployment effects remain, but are insignificant in the pre-COVID sample. So that is also quite intuitive because there was a big shock to unemployment and to bankruptcies at the same time in the beginning of the COVID time. But our results suggest that it did not structurally change the relationship between those variables. So after a short time, it seems that the relationships moved back to normal. Okay, now in terms of the availability of credit hypotheses, we look at the shocks of now housing debt. Here we see strong positive effects of shocks to housing debt. So there's currently a strong positive correlation between housing debt and bankruptcies, but also in terms of consumer debt, pre and post-COVID, or for both samples. And it's less clear for the interest rate in the different models that we run, but at least here on the right side for the pre-COVID sample, we see that there was a negative effect, which is also in line with what we would expect. If the interest rates become higher, there's less borrowing and then also less debt, and then also less bankruptcies in the end. But these results are not borne out by all of our models. So we can clearly identify that there was a correlation between housing debt and bankruptcies, and this holds in different models we run. We see that basically it's the most robust result when we look at all our different methods that loans affect the level of debt that's outstanding, which is also quite intuitive, affects the number of bankruptcies you observe, while the results for the interest rate are less clear across the different models. Then we also look at the hypothesis in terms of information. What we do here is basically a very crude proxy. We use a very crude proxy, the presence of debt counseling agencies in a court district. And then this is a fixed effects regression model where we see, okay, there is a correlation between presence of a debt counseling agency and the number of bankruptcies here per 10,000 inhabitants in this court district, which increases by around 2 cases, which is substantial in this time series. There are, I think, around the average is around like 15 cases per 10,000 inhabitants. But there is, of course, a reverse causality issue here because you could have more information through the debt counseling agencies, and then that could lead to more people going into bankruptcy because they're better informed. But you could also have debt counseling agencies where there are more cases. And we looked at this also with applying a diff and diff estimator. And this is just suggestive in the sense and serves to illustrate that we already have positive pre-trends in those court districts that were actually switching that had a switch in debt counseling agencies. So either there was a debt counseling agency opening or closing, and basically we saw that it was the case for these very few switches that we could observe in our sample, which were 6. That those were also court districts that already had either higher or lower bankruptcy cases.
Our treatment here is whether a court district had a new debt counseling agency or not.
Yes.
Or one more. Or can there be more than one in one district?
Yes, to some extent that's also happening, but the way we coded it was only an indicator, which is 1 if there is an agency present in this court district. Yes. Yes, and we do not make any attempt of like representing this as a causal result. This is just for us to explore the relationship between these different variables. And if we see that there were pre-trends that suggest that that there could be a reverse causality issue, which is why we conclude for this question that our data is not good enough to claim or to examine the information effects of debt counseling agencies, which is something we need more detailed data for. However, we see from the literature that debt counseling agencies can have an impact on the quality of the bankruptcies. So not only now looking at the quantity of bankruptcies, but also the quality. And it's actually a little bit unclear in the literature what effects debt counseling agencies have, or beyond that, also who are the clients of debt counseling agencies. And we are able to look at this by means of the Austrian data, but only for Tyrol and for Vorarlberg, because in those states, apparently the courts are more rigorous in recording when a debt counseling agency was present in representing the debtor in the case, while in the other states, the courts are not as rigorous, and so there's a lot of missing information or mismatches. But for Tyrol and Vorarlberg, we saw that it matches quite well, and so we were able to examine these different client groups of debt counseling agencies, and we saw that especially more vulnerable groups are represented by debt counseling agencies. And this is also important because a lot of studies in this literature just use debt counseling agency clients to study the bankruptcy population, which is, as we see here, much broader. And in terms of outcomes, we were then also able to look at some of the outcomes of these cases and how they relate to debt counselors and lawyers. Here, these are only OLS regressions, so we are comparing averages, and we're not including other covariates. But at this level, we see that when there is a debt counselor involved, cases are less likely to be rejected, less likely to be denied self-administration, and also with debt counselors, it's more likely that individuals go into proceedings for income levy, and less likely that they are in a payment plan in the end, which are different policy options in the bankruptcy proceedings. The time of the court hearings is lower when debt counselors are involved, and also the total duration is lower in the proceedings of income levy, which are these proceedings where individuals now can take up to 3 years, but in the past up to 5 or 7 years of having their income reduced to the existence level. So quite interestingly, also we see that lawyers extend the duration of the court hearings, but as I said earlier, we didn't control here for other covariates. So basically, this is also driven, of course, by the types of clients that debt counselors and lawyers have. Okay. Just briefly, I'm not going to go into every detail here, but this is just illustrating the two FX regression models for the state quarterly data. And in terms of socio-demographic effects, we can observe that the more children there are, the more bankruptcies we observe, which is in line with what we would expect from the literature. However, if the share of the 30 to 44-year-olds is higher, then this is is negatively associated with the bankruptcy rates, which is a bit strange because this is the group that mainly goes into bankruptcy. On the other hand, we see that the loans here are also significant, which is something I pointed out earlier, and there's a mildly almost significant effect or relationship with the share of people who only have mandatory schooling. Okay, but this is our final results slide here, and now we already come to the conclusions, and Stefan is going to take over again.
Yeah, thanks. Yeah, so to sum up this, as you've seen, there's different types of data and multiple hypotheses, but if we want to assess, okay, well, what's relatively more important or where the evidence is more robust and where it is less robust, and we would conclude from what we've done here that, of course, bankruptcy policy parameters really matter. So we've seen this one example of the reform in 2017, which by announcement led to a drop as an anticipation effect of people because they knew that later it would be easier to go into to open a bankruptcy proceeding. So there's a huge effect of that reform. So the cost and benefits obviously matter, and people think about the cost and benefits of going into a bankruptcy proceeding, which is also associated with some transaction cost, time to organize yourself, go to the courts, etc. Second, all the variables related to credit, so debt matters, and both housing and consumer debt matters. And this is also as we see the robust result across our specifications, both with the VARs, but also the panel regression. So we see that, again, talking about aggregate data, so we talk about debt per capita, for instance, and we see that the higher the debt levels across time, across federal states, across court districts, the higher the number of bankruptcies. So the supply and demand of credit access matters, and this also we think is some important policy conclusion or policy implication. Also, we think about the new reforms of the access reforms for people who want to apply for mortgage loans. So obviously that's seems to be an important policy parameter that is reflected in changing number of bankruptcies. On the other hand, for the information effect, our data is not really suitable, so we were more optimistic when we start with that. But as we've seen, reverse causality issues are a problem here. So, inconclusive here for the hypothesis concerning information. But on the other hand, if we stay in this, if we talk about this research question about the role of debt counseling agencies, it seems that when we look at those that have a high likelihood to have a debt counselor instead of a lawyer, that these NGOs, these debt counseling agencies, are able to kind of match with those target groups that they are also aiming for. So those that have kind of a lower socioeconomic status, the unemployed are more represented in among those that use debt counseling agencies for their proceeding. Blue collar workers are disproportionately represented among the group that use debt counseling agencies versus lawyers. So we see that this kind of works, and they find each other to some extent. And finally, our second and fifth hypothesis that was related to the question of the social demographics on the one hand, and macroeconomic variables, more concretely GDP and unemployment rates. So here we see first, for the unemployment rates, they seem to have a negative effect. So this is counterintuitive. So if unemployment rates go up, then bankruptcies decrease in the short run. It's difficult to find, or we have not yet found the optimal lag structure here, but this is what we find when we look at the actual data. And also divorce rates do not seem to play a huge role here. We also talk about the zero levels because if we go into the literature that uses individual level data, for instance, so data observed for persons, and then it is checked, well, did this person had a divorce, and then controlling etc. variables for other variables. Usually there are positive effects are found, so these type of economic shocks, having a divorce, also becoming unemployed, tend to have positive effects. But there's also lag structure here in the literature, so usually these effects are not immediate. So to build up over time, people get unemployed, and then there's other problems coming into it, and then eventually people declare themselves bankrupt. So yeah, this is kind of deviates from the literature what we find, but again, we think it's maybe because aggregate data doesn't seem to be the best source to examine these type of hypotheses that are related with shocks that happen at the individual level. Also, the literature on the unemployment rate and its correlation with bankruptcies usually finds a positive effect, but for GDP it's less clear, and for the business cycle it's also less clear how this affects the count, the number of private bankruptcies. Yeah, that's our main conclusions. Before I conclude, there's also what are our further plans. So this project is almost finished now. We are refining the working papers, but we're interested in doing also comparative studies with US data, and also comparing different type of social policy variables, also to see how much this correlates with differences in the bankruptcy rates. And we're also working on identifying possible effects of slot machine gambling bans in Austria. So this is really regulated by federal law. Some federal states allow slot machine gambling, Automatenglücksspiel, others don't, and there's variation on the bans. And yeah, so very preliminary evidence for Austria. So here you see the variation over time since 1995. Federal states, you see blue means banned, white means not banned. And yeah, what we observe is that there seems to be that indeed, if there's no bans, if we switch from banned to not banned across federal states across time, then in the medium run, we see that this seems to increase the number of bankruptcies. So if we count an effect from relative time to change the law, we see, okay, there's no significant change in the first years, but then starting from year 3, 4, 5, there seems to be significant positive effect if a ban in the state is lifted. But again, this is very preliminary. There's a huge literature on different methods for this type of data structure. It's kind of the research frontier where papers are published every month. So we are hassling in keeping up with the literature here and doing the right specification. Yeah, but that's what we have yet found, and yeah, further analysis here is needed. So I think I'll stop here. And yeah, we are also interested in cooperation. We have this spatial data on bankruptcy, so both in-house and outside the WIFO. If you are interested in this type of stuff and also in want to have a look at our spatial data concerning the accounts of bankruptcies, feel free to ask us questions. And I conclude now and open the floor for questions and remarks. Thank you. I think also played model, Michael.
How did you measure housing debt shocks?
Well, we use central bank data, and with all its flaws. So basically, we have a time series on loans and also on housing mortgages from the central bank. We use these time series, and of course, there are major issues when you break down the time series at the federal state level, because you only have the reporting for the banks in a certain state, but these banks do also business across state levels, and so you have all those topics, but we use the standard BNB time series.
But it's the volume of new household debt or the outstanding amount of debt, or
it's the outstanding amount of debt, yes. And we use different models and different specifications to examine changes in these time series and how they are related to bankruptcies. And in all those different specifications, we see that there is a positive correlation. And also interesting, maybe in the literature, we see that consumer debt is a very important factor for bankruptcies, right? Because that's also the part of the debt that you can usually get rid of by bankruptcy because it's unsecured. But in our results, we see that housing debt also plays a role. So that's something that we basically add here for us and for the Austrian situation, that housing debt, even if you lose your house, it also plays a role to the overall indebtedness of the individual and drives bankruptcy cases.
I'm a bit skeptical on the EAR approach here, because at least I do not really get why you use the system view, because you're only interested in the determinants of some things on bankruptcies. And I would guess you have very little theoretical guidance how all these endogenous variables in your VAR, well, how they interact. And therefore, identification is a huge issue. So how you order your variables, how robust is it to different other sorts of identification things, or if you don't have a clear guidance, which what I guess is why not using generalized impulse response things instead of Cholesky, for example. So my question is, why VARs and not univariate? Because we're only interested in univariate responses, and actually, do you really have a good idea how, I don't know what's your endogenous variables in the DRs for how, for example, private bankruptcies affect interest rates, for example, or unemployment rate or so. Yeah.
Thanks. So there's obviously a lot to be discussed regarding this. Why VARs? Well, basically, from the literature, we saw that when you have effects that, like when you on the one hand have factors that drive bankruptcies, and there we can derive from the literature how this effect should look like. But if we don't not only have the determinants of bankruptcies, but if bankruptcies could, on the other hand, also affect these determinants in reverse, then we concluded that we should use VAR models to address this problem of multidirectionality. And for the variables that we include in the VARs, we basically have a good idea from the literature in which direction the effects should point. And in terms of Cholesky ordering, yes, we are aware that this could play a role. We also tried all kinds of different orderings, and we didn't really see any difference in results there. Of course, it would be interesting to even apply other methods, and we are thankful for comments in this regard. Yep, Thomas.
I mean, we know
something about the reasons to go to the bankruptcy procedure. And as far as I know, many of the cases are formerly self-employed persons who had a problem with their business and overstretched the time to initiate their debt and then go into the bankruptcy procedure with a relatively big amount of debt. Then there are young people who are accumulating debt from various purchases, so internet purchases as well, telecom, telecom services or something like this. And the third is probably gambling. So you get addicted to gambling and start to build up debt against the gambling. Do you have somehow access to this information for individual cases? And can you imagine that the addict that I have something to say about this? Or maybe the counseling organizations, they probably have some records about this. Also to give the parliament some inputs to beef up consumer protection law.
Yeah, maybe I go first, and you had. Yeah, so yes, of course. So if we talk about debt counseling clients data, there are records. They have records of their clients, anonymized records, where they also survey like self-reported reasons, and yeah, these are examples what risk groups are in this pool of data. Yeah, the thing is we've seen that this, of course, there's a subsample of all the people that go into private bankruptcies, so we're not sure how representative the reasons are that are reported in this type of data. And yeah, and going further, yeah, if in the edit state itself, the number of like information you have for the person that apply for a private bankruptcy is limited beyond some social demographics. There's some you could get data on the assets that are brought to. Sorry, I don't know the word for Versteigerung, but so there's some information of which type of assets are realized for serving creditors. So this might give you some indication: how wealthy are these people, or at least what's the level of wealth of the real assets. But this is like less related to the reasons. And to go even deeper, and it's also an idea, but it depends on research funding. But of course, you would have to do some kind of linkage of edit data with register data of employment spells, and then see, well, there's a shock in time t at the individual level, and how does this proceed, how they affect the likelihood of people going into private bankruptcy. But yeah, I think the most comprehensive data is indeed with the client's data, but again, this is not super representative for the full population of people applying for private bankruptcy. So this would be a limitation, and we don't have access to this client's data, but it's there, and also the reasons are spelled out quite detailed in this type of data, and also the coverage. I think it also increases over time, so the number of people in absolute terms, but also if we contrast this to the total number of people going into private bankruptcy that are served by debt counseling agencies increases, so the data might get more representative over time, and also become better to answer like these sort of questions you raised.
I would only add that the edicts data is difficult in many ways and interesting in others. What does it mean? So I observed that you can get really detailed case level information on some cases, but this seems to depend a lot on the court district officer who is in charge of the case, which might also be interesting for future research to identify the effects of these court district officers. But what you can do is there are some characteristics that are mandated by law that need to be entered, and there's also some linking you can do across different dimensions of bankruptcy. So if somebody was running a company before, then the company becomes insolvent, right? You see that in the edicts data, and then later the personal bankruptcy is also entered, and so you can link this information. You can also, if okay, at least I thought it might be possible for some cases, but maybe that's also not possible systematically. Yes. In any case, what I wanted to say, one could look at these different dimensions and see if one can link them. There's also data on when your house is then taken away in the bankruptcy, and when it's put up for auction, and you can also link that on the individual level, because it's all entered by name and address and so on. So you could make a database in a separate project and link all these characteristics where there is systematic information. But it's a lot of work. Let's say it like that. It's not readily available.
I think we have not so much time anymore left. I think Alice was first, and then second question.
Thanks for the presentation. It's very interesting. I've just one question, because I know some people working in Schuldenberatung, and therefore I know that at least some of them, about a year prior to the reform, they advise their clients to postpone the filing, because afterwards it would be more, I mean, they would get better off, right? So I was interested in whether you can see that in later, that the findings drop about the reform. That's not at the end. Yes. Okay.
This is probably precisely what we see here. At the moment that the reform entered Parliament, the cases dropped significantly. So this also makes sense. And yes, thanks for this comment. We also thought that the debt counseling agencies had a big impact here.